Let us now look at one of the most important concepts in international taxation, and that is the concept of permanent establishment. Now, if I talk about permanent establishment, the importance of permanent establishment is that if there is a non-resident who is getting some business profit from a source country. So for example, if there is a US company and it is doing business with some other country in the world through which it is earning profits in that country, the profits which the US company generates from the business it does in the other country can be taxed in the other country only and only when the US company has a permanent establishment in that country. Now, what is meant by permanent establishment therefore becomes very, very important. In addition to taxation of permanent establishment or the business profits, the other importance of permanent establishment is that when we talk about the taxability of interest, or for that matter, fee for technical services or royalty, even every clause that is there in a tax treaty provides that if the permanent establishment is there for the non-resident, then the taxation may not be necessarily done under that article. For example, suppose if there is a foreign bank which has a branch in another country, that branch is going to be treated as the permanent establishment of the foreign bank in that country. Now, generally, when we talk about the interest income earned by a non-resident, that may be taxable at 10% of the gross amount. So if the interest amount that has been paid is 100, the tax that may be payable in the source country will be 10. But if the non-resident has a permanent establishment, then the taxation suffers two different treatments. One is that the rate of taxation may change from 10% to some other rate. And the second is, instead of applying the 10% on the gross amount, it might be applicable on the net income. Therefore, it becomes very, very important to identify if the non-resident has a permanent establishment in the host country. So let's understand a bit more about this topic in the next few slides. For a non-resident who is operating in another country, there are a few ways in which he can operate. And the choice of one form of operation over another form of operations depend on few things like what is the nature of work that has to be done, what is the period or the time frame in which that work has to be done, and what is the income that is being generated out of that work. Typically, it is seen that when the projects are for a longer duration, generally the foreign company would tend to operate through a subsidiary. A subsidiary is what? It is a separate legal entity. So let's say in this case, the foreign company based out of foreign state incorporates a 100% subsidiary, ESCO, in the source state. The subsidiary is a separate company and it is liable to corporate tax in the source state based on their tax laws. So for example, if the source state were to be India, the foreign company may be liable to tax at the rate of 15 to 30%. So if the income is 100 and the tax rate is 15, let's say the net amount available with the company will be 85. Now, when this 85 is distributed by the company to the parent as, let's say, for example, dividend, there is another set of tax that has to be applied, let's say 10%. So in that case, what is going to happen is 85 is distributed as dividend. So whatever is the amount of dividend, let's say 85 is the dividend, 8.5 or 10% of the total amount will be deducted as withholding tax. Now, because there is two layers of taxes which are involved, one is the corporate tax and the other is the dividend tax, the total tax that may be applicable through a subsidiary may be higher compared to a situation where the tax may not be applicable if the company is operating directly. The second thing is that whenever a company operates through a subsidiary, there are a lot of compliance costs also which are applicable, like the audit fees, the tax cost, and employee cost, etc. All these costs are applicable when the operations are done through a subsidiary. So wherever the operations are not destined to be over a longer period of time, what the companies do is that instead of operating a subsidiary, they may choose to either open an office without having a legal entity, they may operate through an agent, or they may even work at a particular site, depending on the nature of work. Let's look at the alternative options which are available if a company does not want to operate through a subsidiary. One of the accepted principles in international taxation is that a subsidiary is basically a separate legal entity. And because this is a separate legal entity, just because of the fact that the foreign company owns 100% in this entity, it would not by default be treated as a permanent establishment of the foreign company in the source state. It may still constitute a permanent establishment if it is doing one of the activities which a foreign company has to do. But merely because of the reason that a foreign company has a subsidiary, it will not become a PE, a permanent establishment of the foreign company in the source state. So now we'll move on to the next slide and see what are the alternate options available to a foreign company to do business in the source state. Thank you for watching our video on international tax. In case you want to subscribe to our full course, you can go to the link courses.sortingtax.com. If you are an Android user, you can download our application, and when you go to this link, you can purchase the course here. In case you are looking for a different currency of pricing, you can click on the link given in the description here and purchase the course. Thank you.